The Fed just cut interest rates, and the US's GDP numbers post-pandemic were just revised up. And now we've got lower interest rates and another potential major issue that could lead to one of the greatest melt-ups in history. And today I'm going to tell you what this all means, how we could not be out of this massive inflation issue that we've faced for the last 2 years, and what you can do to protect yourself. And it's important to note here that even though this could be a looming crisis, out of crisis comes opportunity. And there is, in fact, no matter how hard things seem, opportunity at every single turn. But before we get into the details, my name is Nolan Matthias, and if you want the truth about finances, the truth about economics, then go ahead, click that subscribe button, and hit the like button so more people like you can see this video. Okay, so let's get into it. Let's discuss what's going on in the US economy, because things could be getting a lot worse before they start to get better, as we see new economic data that suggests that things weren't actually as bad as we thought they were. And of course, we've got that massive Fed cut, which could be inflationary in nature, especially considering the fact that all of the GDP numbers that were just revised up show us that the economy was actually doing better than we thought, which means we're actually reducing interest rates in an economy that is outperforming what we expected, which obviously has inflationary tendencies. So I want to jump you into the news here and show you exactly what's going on. Because just a week ago, it seemed like everything was normal. We're getting rate cuts. There's going to be more rate cuts. And now this conversation is getting a lot more interesting, especially when we get into a second, the post-pandemic numbers with respect to GDP and how much higher than expected that actually was. So Fed Chair Jerome Powell said Monday that the recent 0.5 percentage point interest rate cuts shouldn't be interpreted as a sign of future moves, and primarily that those moves probably in the future won't be as aggressive. And everything that's going on right now suggests that they almost certainly will not be. He also suggested that they're not on any preset course, which means they're going to look at the data. And by the way, the data just got really confusing with everything that's going on here. So as we look into this article, Federal Reserve Chair Jerome Powell said Monday that the recent 0.5 percentage point interest rate cut shouldn't be interpreted as a sign that future moves will be as aggressive, in fact, indicating that the next moves will be smaller. And yes, of course, given what we're seeing right now, it's almost guaranteed that those next moves will be smaller. They may not even actually happen. Now, what they're hoping to do is seek to bring balance, bringing down inflation and supporting the labor market, and let the data guide the future moves. Looking forward, if the economy evolves broadly as expected, policy will move over time towards a more neutral stance, but we are not on any preset course. So in other words, if things change in the economy quickly, well, obviously that could change the preset course or the lack of preset course. The risks are two-sided, and we will continue to make our decisions meeting by meeting. Powell did indicate that if the economic data remains consistent, there are likely 2 more rate cuts coming this year, but in smaller 0.25 percentage point increments. Well, as of right now, the data points are not remaining consistent. We've got potential inflationary pressure from the port strike, and we've got higher than expected GDP numbers that could throw this completely off the rails. And that stands in contrast with market expectations that saw interest rates coming down significantly more than what the Fed is actually suggesting they are going to do. So now this looks like the Fed has the data and the information they need to actually decrease interest rates less than they had previously led people to believe or insinuated that they might do. Now, Morgan Stanley's Ellen Zettner went on to say that this is not a committee that feels like it's in a hurry to cut rates quickly. If the economy performs as expected, that would mean 2 more rate cuts this year, a total of 50 basis points more. Now, stocks fell as Powell spoke about what they expected to happen, because obviously the market was predicting more rate cuts. He's suggesting that that won't necessarily be what happens, so the Dow acted accordingly. But here's where it gets even more interesting. The Fed drives global push to cut rates despite questions over 2025. And yes, there are significant questions about what's going to happen with inflation in 2025. It is not a foregone conclusion at this point that inflation is going to come down to where it needs to be globally. With the last traces of global inflation shock fading, the shift toward lower borrowing costs is about to maintain momentum as economies tread toward a new year fraught with unknowns. According to Bloomberg Economics, the aggregate gauge of advanced economy borrowing costs shows a decline of almost 40 basis points between now and the end of the year, so essentially 2 more rate cuts, and a further drop totaling more than double that amount by the time 2025 is out. You can see it here in the chart that it is very much expected that interest rates are going to come down significantly by the end of next year. And as you can see, throughout most of the G7 nations, we're expecting to see lower interest rates. Those are the ones denominated in pink. Then we've got several countries that we're expected to see unchanged interest rates, places like China. And then we've got certain economies where we expect to see higher interest rates, notably Russia. And the most significant one here is Japan, the one major Western economy that isn't expected to see rates come down. In fact, they're expected to go up. But this is the most important point, and this is from Bloomberg Economics. The Fed's half-point move and the PBOC's surprise stimulus means the narrative on central banks has shifted from inflation-crushing hikes to market-boosting cuts. The second may come from the U.S. election. If delivered, Trump's campaign pledges on taxes, tariffs, and deportations would shift the trajectory for the economy and force the Fed into another course of correction. In other words, they may have to increase interest rates. But all of this is just creating more noise that is going to make it harder for the Fed to really understand the data of what's coming in November when the next Fed rate cut is expected. You've got the US GDP numbers for the last several years being revised, and that could make things significantly harder to justify lower interest rates, especially when you've got all this inflationary pressure. You've got data to show that the US economy has actually been performing better than expected, and therefore you've got this issue where now we're decreasing interest rates, but the economy is working better than it should have, which means we're actually decreasing interest rates in an economy that is performing better than expected, which you don't have to be a rocket scientist to figure out has inflationary pressure. And there's one more big fear, which I'll get to in just a second after I go through this article real quick, because there's some important things that you need to understand based on this. The US economy bounced back from the pandemic in stronger shape than previously estimated, spurred mainly by bigger consumer-driven growth fueled by robust incomes, according to revised government data. Upward revisions to the saving rate paired with still strong consumption means less risk that a higher saving rate will slow the consumption and that there's more saving buffer than previously thought. The government figures also showed an upward revision to 2023 GDI, or the income generated and cost incurred from producing goods and services. Inflation-adjusted GDI growth last year was boosted to 1.7% from 0.4%. That is almost 4 times what it was previously estimated at. The revision shows that the ancillary income some Americans receive was more robust than previously measured to. The strength may help explain why consumers were able to spend more freely than many thought possible. The annual update also showed a sizable increase in corporate profits in the 5 years through 2023. Earnings were revised up $288.5 billion for 2023. The expansion that started in the second quarter of 2020 is so far among the best since the aftermath of World War II. And all of this leads us to a pretty simple conclusion. The economy is simply way better than we expected that it was. And all of this stuff, whether it is reducing interest rates or whether it is the fact that the economy has performed better than expected, those are all inflationary pressures. And the big fear here is that we see a massive melt-up. The reduction in interest rates is too soon, it's too much. Inflation rears its ugly head again. We then have to see the course corrected and higher interest rates in order to make up for the damage that's done by lower interest rates, and therefore we end up in the exact same situation that we were in previously. And then the question becomes, how do you protect yourself from this? Well, if you're one of those people who's sitting on the fence trying to determine whether or not it makes sense to buy a home right now, things like real estate tend to go up in value when there are melt-ups. People who have assets, things that will go up in value during inflationary periods, are the people that will perform the best. And by the way, the people who have the most debt and don't have assets to back up their wealth, those are the people that are going to feel the most pain. And this is where the rich get richer, the poor get poorer. It is purely a distinction between the assets that you have that go up in value versus the amount of debt that you carry that make it significantly harder for your net worth to increase. So if you've been sitting on the fence, like I said, on buying a home, now might be the time to do it so that you have an asset that is real, a hard asset that will go up in value if we start to see inflation rear its ugly head again. And same thing for buying all other types of assets that go up in value during inflationary times. And yes, absolutely, we talked about this before. You probably shouldn't be buying physical gold and silver, but having a balanced portfolio that includes gold and silver in it is definitely a good idea, because as asset values start to go up and there's inflationary pressure and there's fear in the market, which could be something that is coming down the road, maybe in the next year, maybe in the next 2 years, those assets like gold will have a tendency to go up in value. Now, that doesn't mean you should be putting all your investments into gold, because quite honestly, The last time that I made a video about selling gold, which was in December of 2020, was pretty much the top of the market for that period in time. I sold all my physical gold and silver. Yes, I still keep about 5% of my portfolio in gold and silver, albeit in ETFs, in order to balance out the fluctuations in the stock market. But that point at which I sold all of the holdings I had, since then the S&P 500 has significantly outperformed what gold has done, even though gold has hit all-time highs. And then when it comes to building a diversified portfolio, I like things like the all-weather portfolio, which no matter what's happening in the economy, tends to do fairly well. And that is strictly because you own varying different types of assets, you rebalance on a regular basis, which means you are buying when certain things are cheap, selling when certain things are overvalued, like gold right now, and as a result, your portfolio can weather pretty much any economic storm. Oh, and by the way, I'm not saying that a recession is coming, but at some point it will. There could also be a reverse crash or a reverse recession where things go up in value quite substantially like they did in 2020, and I'm going to be releasing a video on that later on this week. But as for right now, if you want to see a video on what happens leading up to a recession, make sure you check out this video right here.